Hello guys, welcome to P2 Corporate Reporting with me, Martin Jones. This is the London School of Business and Finance, and as I say, my name is Martin Jones and I am here to present to you through the channel of Interactive. The subject matter for tonight is Corporate Reporting, ACCA P2 Corporate Reporting, and I have a slide over my left shoulder to prove this. I'm just going to go mini-me now. There I am. And over my left shoulder is appearing what is in fact in front of me in the screen, which is of course the name of the course, ACCA P2 Global Live Sessions with me, Martin Jones. And there is my email. Welcome to this, the second of 8 evenings. I will just do page down. Oh, that didn't quite work. Let's try again. I will just do page down. If I can persuade this thing to move. There we go. I will just do page down and remind you what we did on the first evening. We did basic groups, leading to us to be able to do simple consolidation and accommodate goodwill impairment. But of course, what we didn't do was finish the complex parts of basic groups. Changes in ownership is a very big deal. And it's hard, you know, I've called it complex groups actually on this thingamabob here. But it's difficult to know. It's a basic technique in the sense that it comes up very, very frequently, but there's nothing simple about it. It's one of the hardest things on the entire syllabus. So the subject matter for tonight is, well, we're doing complex groups, right? But that means finishing chapter 1 and doing the whole of chapter 2. So chapter 2 is a whole chapter, isn't it? So you might be thinking to yourself, come on, Martin, we can't finish chapter 1 and do chapter 2 in an evening. Actually, complex groups is really not that complex. I mean, don't get me wrong, it's not dead easy, but what you do in the first hour and 20 minutes, hour and a half is much harder. Finishing off basic groups, the back end of basic groups there's some feral rocket science in there, if I'm honest with you. And then complex groups, once you've done changes in ownership, you can knock anything on the head. So the last 40 minutes doing changes in ownership, you'll be cool. You'll be absolutely cool. So that's the subject matter. I'm just going to go back to and show this fella over my shoulder. Yes, indeed, we're doing complex groups, and I'll talk to you about the homework when we get there. Okay. So I have a blank Windows journal. Actually, it's not. It's a generic journal. That's called Note, and there is the baby. Appearing over my shoulder. I haven't done my favourite tests just to make sure that you are there and you're alive. So I'm going to look over to the left hand side. I did notice you chatting amongst each other earlier, but I'm just going to make sure that you can see me and everything's cool. So just let me grab a pen. Here's a pen. So what is it that I am writing on my screen just now? So I don't know why I'm writing in grey. Changes. What is it that I am writing on my screen right now? What is that word over my shoulder? I'm gone for grey, haven't I? That's not very good. Black is a better colour. Tell me the word over my shoulder up there. Looks a bit pale, doesn't it? Yes, good stuff, Cressy. Nice to see you. Ian, Terry, hello to you guys. Fantastic. I like to do that test. It just gives me the confidence that I know that I'm coming through to you. And of course, the subject matter for tonight is changes in ownership. My pen's a bit weird tonight. It's a bit sort of blobby and changeable. I don't know why that is. It was the same on Tuesday as well. Changes in ownership. There are four. There are four. And this subject is usually represented on an ownership line. It's a little bit cheeky because technically it's not 100% right, this story, but it works extremely well as an illustration. So in simple groups, 50% ownership gives you 50% of the votes and gives you control. 0%, of course, is nothing at all, and 100% is total ownership. But in most circumstances, in most questions, most of the time, 50% gives you control. And what I'm going to have is I'm going to have hoopla, one arrow, followed by another arrow, chupa, followed by another one, ucha, followed by the last one, uncha. And as you're copying me out, and I hope you do copy me out, just get roughly the right idea about these fellas. What fellas? Well, you've probably guessed that the pair, which way is it? The nearest to me, aren't we? Yeah, the pair just over my shoulder and nearest to me, above the line and below the line, are all about getting control and losing control. And getting control is called an acquisition. And losing control is called a disposal. And there are two questions. I've got my paper here in front of me. Of course, I've got my notes down here as well. But I don't want to flick to them just yet. So I've got my paper in front of me. And I'm still at the back end of the basic groups chapter. I'm flicking about all over the place, trying to find the pop stars. We're doing the pop stars today. So we're doing Lady Gaga, Adamant on page 24. And then we're doing Iggy Pop and Busta Rhymes on page 25. That's the action for tonight. And most of tonight's going to be spent doing those two fellas. So I'll just label those in bright red. We've got Lady Gaga over here. And we've got Adamant down here. Lady Gaga's dead easy, but Adamant not quite so easy. And the two on the right hand side are proper tricky. They are both representative of what's called a transfer. And there's two directions of transfer of ownership, hence the need for two questions. The first one's Iggy Pop. Question Iggy Pop. Question Iggy Pop. And the second one is Busta Rhymes. Question Busta Rhymes. And and we're going to do all four. We're going to do all four over my shoulder. But actually this is tricky stuff. So pretty much what I'll be doing is I'll be doing two of each. I probably won't end up doing 8 exercises. I'll probably end up doing 7. But I'll pretty much be doing 2 of each. So 2 Lady Gaga, 2 Adamant, 2 Iggy Pop, and probably not an extra Busta Rhymes. But maybe, depending on how time goes. Starting now with acquisition and disposal. So what's an acquisition and disposal all about? Let's get into that. Go for a black pen here. Acquisition and disposal. An acquisition occurs when we get control. A disposal occurs when we lose control. I feel like I bunched that up a bit much, but there you go, it seemed to fit on 2 lines. An acquisition occurs when we get control and a disposal occurs when we lose control. There you go, that's the facts. So going up a little bit, if you'll allow me, up to the little picky that we have over our shoulders here, over my shoulder, acquisition Lady Gaga, disposal Adamant, you know, that's what we're doing. We're doing that now. Lady Gaga is so simple you can launch straight into the answer. I've got the question over my shoulder actually, I'd like to bring it up for you. So there is the notes, looking a bit scruffy because I've scrawled all over them. So I'll just tidy that up a little bit, and then I'll go down to page 24 and I'll find that for you. What's the best way of going to 24? Probably this way. Different programs work different ways. Sorry about this sliding past your eyes there. It's probably making you a little bit queasy. But that's the way this fellow works. So there's Lady Gaga, and you know, I've got the paper in front of me, but I want to read it with you. So I'll be looking down as you're looking down, or I'll be looking down as you're looking at me. This is really cheeky. You learn a little bit about your examiner, Graham Holt here. You definitely learn that. There we go. Let's get some colour. Pink, horrible pink. At the year start, Lady acquired a 10% interest in Gaga at a cost of 25%. Lies! Cheating, evilness. The examiner is using the word acquired to try and make you think of an acquisition, which is the getting of control of a subsidiary. And of course, in simple groups, 10% is nowhere near enough. That is not an acquisition. At the year end, Lady acquired a further 45%. Now, this 45% in isolation would be insufficient for control, but it's not in isolation. It's on top of the former 10%. I don't know how that pink looks to you, but it looks horrible to me, so I think I'll get rid of it and go for yellow. So 10% and 45%, that's better, isn't it? It gives us 55%, and in simple groups, that would be 55% of the votes, and therefore sufficient to sack directors, sufficient to give us the power to direct activities. So the event at the year end is called an acquisition, and at acquisition we calculate goodwill. So the goodwill is being requested at the year end when we get control. Okay. And what else should I say? I don't feel like saying anything, so we'll have a look at the detail of the question in a moment. Let's just do a schedule for goodwill. A strange pen, it looks very odd to me. So Lady Gaga is asking for goodwill. How's it come across to you? It looks alright, doesn't it? Strange pen though. Could do with being thicker, but there's no thicker function. Should I try and get a thicker function? Tools, pen options. Should I try very thick? See how that goes. So we've got, I don't know, it looks even more weird. Is that better? Fair value of consideration. I think that probably is. It's a bit blobby. Can you see these blobs? It's almost like the pen was a real pen and like the ink was a bit out of control. Gosh, that just look weird, doesn't it? Fair value consideration. I think that's worse, you know. I think I'll just go back to the other function. I hope you don't mind. It's still got the blobs, but at least it doesn't look quite as weird as the other function. So there's the percentage. We'll have a working, and then we'll calculate the sub goodwill. Like so, like so. And I admit it's in this baby question. We don't actually need the working, but when you get to the examination, you'll have foreign transactions involving foreign consideration or deferred consideration or foreign deferred consideration. So you do tend to need the workings when you're in the examination, not so much in these baby questions we're doing at the moment. So what was the story with the ownership? It was, 55%. Now the way to represent your 55% is as follows. What you do is just sort of bunch yourself up a little bit. You go 45% and 10%. It's a bit difficult for me to write this on this rather miniature little screen that we have here, but I wonder if I can get in there a little bit. Does that help a little bit? So there you go. So it's 45% and 10% is what we're looking for there, highlighted in yellow. So 45 and 10% is the 55%, and of course, the remaining NCI is the other 45%. Okay, I'll just come back out again for that. How do we do that like that? There you go. So, yeah, there's the percentages, and then we'll have a look at the data and basically copy it into place, and you'll see that it's just a copying exercise. At the year end, Lady acquired a further 10% interest in Gaga at a cost of 25 million. Did I read that wrong? Can I just read that again? At the year start, Lady acquired a 10% interest in Gaga at a cost of 25 million. At the year end, Lady acquired a further 45% interest in Gaga at a cost of 120 and obtained control. The fair value of the initial 10% interest at this time was 27, and the fair value of the NCI was 110. The fair value of the identifiable net assets was 150. And the examiner's just saying, here's a load of data, would you like to copy? And we go, yeah, I'd like to copy. So 150, I'm working backwards actually, because I don't know why I just am. So the fair value of the net assets is 150, fair value of NCI is 110, so 110. And now I need the fair value of the 45%. The fair value of the 45%. Now can you see the 45% cost as 120? And that 120 is a cost, but it is also the fair value. I've got a half-drunk aloe vera drink from Wasabi just next door, and delicious it as well, but it certainly isn't worth its full price because I've actually drunk some over there. But when I paid £1.95, that's a lot, isn't it? When I paid £1.95 for that asset, at that point it was worth £1.95. You buy a flat in London for £400,000 today, £400,000 for a flat. You buy a flat for £400,000 in London. What is it worth at the point that you pay £400,000 for it? £400,000. So the fair value of the 45% is what we paid for it at the time that we paid for it, which of course was 120. But that's the game, you see. When the schedule says fair value, the schedule means fair value. And the only place you can go wrong is in the context of this 10% here, because there's two figures for the 10%. The two figures available for the 10% are 25 and 27. And the one that says cost is the cost, and the one that says fair value is the fair value. What do you reckon? When you're doing the fair value, do you think you should do the fair value or the cost when you're doing the fair value? The answer is when you're doing the fair value, you do the fair value, obviously, which gives us 27, and then we add down, and there you go, that's the goodwill. I probably should work it out in my head, but I'm feeling a bit lazy. So that is really lazy though, isn't it? So minus 40, 107, there you go, it's much quicker than a calculator. So calculator gives, sorry, my calculator, my brain gives me 107, and that's it. That's the answer. That's it. And that's 3 marks in any examination. Very frequently examined. Not quite every exam, but once a year at least. But hang on. I take a look at the question. The question's not asking us about the 2. What 2? Some of you might have spotted the 2. So even though the question doesn't ask us, let's look at the 2. What 2? Gain. By the way, the gain of 2 million is reported in the P&L. Just take a look at the question where we ask for that. No. So it is very much by the way, but you might feel more comfortable with that written down. Oh, what 2 million? Well, the asset had a year-end fair value of 27, and at the year start it had a cost of 25, at a fair value of 25 at the year start, and its fair value has gone up by 2, and that gain goes to the P&L, as you can see. Okay. Good stuff. Now that was relatively easy, and I'm going to do something a little bit strange, which is I'm going to make the subject matter harder. And the reason I'm doing that for the question Lady Gaga is you need the conceptual basis of you need the conceptual basis of Lady Gaga to do Adamant, really. It's all about Adamant. Lady Gaga's dead easy, you don't really need to understand what you're doing here. But you can't do Adamant unless you understand the concept in IFRS 3. So you might as well understand it for both. It's going to be a little bit painful this, but hang in there. Here we go. Oh goodness, what did you do then? IFRS 3 requires, I've got a skinny pen, let's fatten that up a bit, that we go through zero ownership when there is a change of relationship and entity. Do you remember me saying this? And I started talking about relationships and entities. And I imagine, you got as far as me, which is I got as far as having the three relationships down. 3. There are 3. But like I said, it's a bit hard to describe these 3 as 3 because it's really 2 and the absence of both. So relationships. There's control and influence. And neither. And this is as far as I got before I crashed. So let's see. Let's hope it works this time. Excuse me, guys. What beginning with S? Well, that's a bit of a naff pen, isn't it? Try again. What beginning with S, there we go, is the entity over which we have control. What beginning with S is the entity over which we have control. What beginning with S is this fella in orange. What S is this fella in orange? I'll have a drink. Well, oi, very good. Subsidiary, absolutely right, fabulous. Good stuff. And influence is associate, and neither is a simple investment. Okay then, Martin. How does that relate to... I get you. Of course, my 10% investment that I held for the year was a 10% investment, and I went from a 10% investment to a 55% sub. So I did this hoopla like that. There was a change of both relationship from neither to control, and there was a change of relationship from neither to control, and there was a change of entity from investment to subsidiary. If I just take you back up to this sentence here, the back end of the sentence is applying quite clearly. We can see that now. So I'll just see, you can see that IFRS 3 requires that we go through zero ownership when there is a change in relationship and entity. You can see that there is a change in relationship and entity, but what we still haven't got is what on earth are you talking about in the context of zero, Martin? I'm not seeing that at all. What IFRS 3 requires as regards Lady Gaga, just up there, now disappeared, is that we we tell the little lie to tell the big truth. And what we do is we pretend that we sold the 10% investment and purchased a 55% sub in Lady Gaga. Clearly that's not entirely true. What actually happened is we bought 45% of equity on top of 10% of equity, and it changed our relationship from neither to control, and therefore swapped the investment into a subsidiary. But you know, that's making my eyes spin round in my head trying to even explain that. That's a really complicated thing, and financial reporting is not good with subtlety and complication, so we have to tell a little lie to tell the big truth, which is, the little lie is that we sold a 10% investment and bought a 55% sub. But that's the application. And you'll actually see it in the answer. I can't show you, unfortunately I can't show you Lady Gaga because Lady Gaga's gone. Look, if I show you the top of my screen, that's the top of my screen. I can't go back to Lady Gaga. Lady Gaga's gone into the ether. But I can give you another example and I can show you how it works there. But I'll do the application to Lady Gaga first of all. So in Lady Gaga, we pretend we have sold a 10% investment and bought a 55% subsidiary. And IFRS 3 requires that we have this logic. We're required to do what I've just described there. It is a requirement. I don't feel like hanging around with that. I feel like just doing another example. Let's do another example and I'll show you what I mean with that other example. So I'm just going to make up an example. I'm going to call it example 1. Let's not go with any clever names. And I'll just make it up as a parallel to Lady Gaga. So, at the year start, a parent buys 13% of equity for 13 million, say. At the year end, I'm making up this exercise here, just making it up off the top of my head, so you need to copy it down. At the year start, a parent buys 13% of equity for 13 million. At the year end, the parent buys another 37% for 40 million when the earlier 13% has a fair value of 14 million. At the year end, the parent buys another 37% for 40 million when the earlier 13% has a fair value of 14 million. And NCI was 20 million and net assets were, well, let's keep it simple, 15 million. And the requirement is goodwill. let's first of all show that we don't really need to understand the zero concept in order to do example 1. You just slap down the answer without any great thought. But then let's apply the zero concept, and I'll show you then why the zero concept is so important to Adamant. Okay, so let's do the answer first. Let's just slap it down. Here we go. Let's do that doubling up of percentages. 37% on top of 13 gives us 60, doesn't it? And it's not wrong to do 60 like that. It's technically correct, it's just not terribly helpful. So what we'll do is we'll do the 60 in the way you saw earlier, which is 37 and 13. I hope that's visible. I mean, if it's visible on my screen, I've got an absolutely tiny little screen there. I mean, it's literally this big, and I can still see myself in my writing, so it must be all right at your end, I guess. 50%. 50%. All right, sorry. I've made a mistake. Thank you, guys. Let's change our exercise. But 37% for 40, but 47% for 40. Oh no, let's have, what shall I do? Let's have 38%. Let's have 38%. Can I change my question? So I'll just highlight where I'm going to change, because I've got to change something. 50%'s no good. 50%'s no good. It is usual to have control with 50%, but it's too marginal. I don't want to be playing with 50%. The examiner never does, so why should I? So let's have that 37%. Let's have it and change it. So it's going to go to 38%. Then I've got control, right? So I'm going to just do that in red. I'm going to go, how's that looking? No, not that one, kind of red, this kind of red. 38%, so 38%, there we go, so 38%. Thank you, guys, for correcting me there. So it's 38% for 40. Oh, okay, now we're sorted. So I've got, I'm going to do this. I think I'll just tidy up again and start again. Okay, let's start again. Rewind my way back. 51% now. How am I doing now? 51% and 49%. That's better, isn't it? But the thing is about this 51% is this 51% is technically correct, but it's not very helpful. That was what I was saying, wasn't it? So I'm going to change that using fancy technology. Like that. I change that. How am I doing with this fella? Do bop, butcher bop. There we go. And I'll do 38% and 13%. And then everything's cool. It's better, isn't it? We're much happier with that. So then you just drop in the data. I expect you finished this question 20 minutes ago. But I'll try and catch up with you now. See if I can just change the presentation. And if I do that, that helps me a little bit. Have you ever done that for you? It might be a bit tiny for you, but it'll help me to actually answer my question. So I'll work backwards again. So net assets were 15. All right, that's a bit too small even for me. So I'm just going to make that a bit bigger. There we go. Yeah, there we go. So 15. Washa, like that. What was the NCI? 20. So the NCI was 20. And what was the 38%? Buys another 38% for 40. That's very difficult to write at this scale. But I'll make it bigger in a second. And then, oh yes, of course, there's only one figure that you can get wrong. I don't know why I'm talking to the screen. I should be talking to you. There's only one figure that you can really get wrong, and that is the two figures available for the 13%. the two figures available for the 13% are, I'll just put yellow, I like yellow, are 13 and 14. And of course, when Goodwill says fair value, we use fair value. So we slot in 14. Slot in 14 like that. And it is a bit small for me and for you as well, so I'll go bigger. And what I'll do actually go bigger again. I think what I'll do is just go bigger again just for this. Well, it's maybe overdoing it a bit, but I don't know. It's all right, isn't it? And then I'll add down. Dare I use my head? So that's plus 5, so that's 1959. 59? Yes. And one of you guys has agreed with me, so maybe I'm right. So it's BK Sam. Thank you, Sam. It's 59. Woocha. And I'll just come out a bit because that's a bit horrible, isn't it? So there we go. There's the answer, 59. And by the way, the gain of 1 million goes to P&L. Wait a second. Why is the gain of 1 million going to the P&L as if we had actually sold the 10%? Can I take you back a little bit? I'll take you back a little bit. Here we go. Can you see that I said IFRS 3 requires that we go through zero? IFRS 3 is so strong on requiring that we go through zero that IFRS 3 requires, in the context of example 1, that we really, really do pretend we've sold the 13% and bought it back. Now, if we had sold the 13%, at the year end, what would we have sold it for? We would have sold it for 14. We'd have sold it for 14. And the cost, of course, at the beginning of the year was 13. And that would have created a profit on disposal, which would be real and would go to the P&L. But this fake sale hasn't happened, but the IFRS is so strong on treating the fake sale as if it had happened. You know, you put the profit of 1 million into the P&L. So as if the expression that, you know, is not actually used in the IFRS but is used widely amongst financial reporting guys is that the profit is treated as realised. It's treated as realised like you'd really had sold it. And can you also see what's going on in bright yellow here as well? What we're saying in bright yellow here as well, what we're saying here in bright yellow here as well, is we're pretending that we did buy a 60% sub. If we'd bought 60% sub, how much would we have paid for it? Well, we would have paid 40 for the 38, because that's what we did pay. We would have paid 40 for the 38, and we would have paid 14 for the 13 at the same time. So we really are treating this like we had sold the 13% and bought back a 51%. I think I might have said something wrong there at some stage. But we really are treating it as if we'd sold the 13% and bought a 51% sub. It's cool, isn't it? Ah, but what if you go the other way? What if you go the other way? What way did we go here? What way we did was we went from 13% down to 0, and then from 0 up to 51%. We pretended we'd sold a 13% investment and bought a 51% subsidiary. What if we'd gone the other way? What would you do? If we dropped from 51% down to 13? I know we didn't, but what if? What would you do? Well, the answer is, if we dropped from 51 down to 13, we would pretend that we'd sold a 51% subsidiary and bought a 13% investment. Ah, and that is the basis of question Adamant. So let's do Adamant together. Have I got a pen? Oh, I think it might have crashed again. It's not crashed. It's not crashed. I've got a yellow pen. I thought it crashed, but it's actually just got a yellow pen. Sorry about that, guys. Slightly paranoid now. But it is unrealised, so wouldn't it go to the OCI? No, Troy. It is not unrealised. The definition, sorry, my bottle's in the way there. The definition of realised is that goes to the P&L, and it goes to the P&L. Why does it go to the P&L? Because it's the law. Why is it the law? Because the IASB said so, and the International Accounting Standards Board did. There's a lot more. There's a load more to this than meets the eye. It's much more. Everything's always got layers and layers of sophistication and complexity. But essentially, as far as you're concerned, that's it. That's the answer. And it definitely doesn't go to the OCI unless, of course, there's always an unless and a detailed rule and that kind of stuff. But for our purposes, there you go. Whack it into it. And don't start. Be careful with that word, realised and unrealised. The realised and unrealised exists nowhere within IFRS and only exists within the culture of financial reporting. It is totally undefined, and it is a difficult phrase to use, and it is very unlikely to get you any marks, so don't go there. It was the subject of a big question, a 25 marker in June 2015, so the subject of realised and unrealised is a big subject, but is so unlikely to get you any marks precisely because it was examined in detail in June. It's not going to get examined again in detail in December, so just keep away from it. But if we're going to mention it, then this is realised because the law says put it through the P&L. Effectively, the definition of realised is that goes through the P&L, and this goes through the P&L because that's what the IASB told us to do in their IFRS 3. As it happens, I can tell you a little bit about the story. I go to the International Accounting Standards Board very frequently, not so much recently, not since I've had my young son. He's 4, so there you go. I haven't been very much recently at all. But before he was born, I used to go quite regularly, and this was debated in 2007, I think it was, and I just happened to be there when, I'm not there all the time, but I do go, and I just happened to be there when the International Accounting Standards Board were debating whether this one should go to the P&L or not. That's what they were debating on the day, amongst other things as well. And the debate was like literally 10 minutes long because they'd already pretty much made up their mind that, if we're going to do this zero thing, we're going to do it properly. If we're going to pretend that we've sold the 13% and bought it back, we're going to really pretend we've sold it and bought it back, not half pretend. So that was the IASB decision. So there you go. It's the law. So there we go. But what I really want to do is question Adamant. Let's do Adamant. Which I have over my shoulder, hidden away, so here it is. You ready? Here it is. This fella's gone back to the beginning, of course, and I'm on page 24. 24, how's this working? Oh yes, I see it's over there. Sorry about the slidey. There's Adam, just bring him up a little bit, there we go. Just concentrate on the two percentages for now. These two, 70 and 25, those two. At the year start, Adam acquires 70, stop! In simple groups, that's sufficient for control. At the year end, Adam sells 25%, stop! That's sufficient to lose control. So how does IFRS 3 require us to account for this? Well, what actually happened is we sold 25% and lost control of a subsidiary. But how much control did we lose of a subsidiary? Control is an on-off switch. Either you have it or you don't. Either you don't or you do. It's an on-off switch. And therefore, we totally lost control. We only sold 25% of the equity, but we totally lost control of the strategy of the subsidiary ends. We used to be able to tell it what strategy to do, now we can't. So we totally lost control of our subsidiary. So what we do is we pretend, can you guess, that we sold a 70% sub and purchased a 45% associate. Okay? Now let's do it. It's a bit weird because of the way this is presented, but it is the usual way that this kind of stuff is presented. At the year start, Adam acquired 70% of Ant for 460 and had identifiable net assets with a fair value of 300. At acquisition, the fair value of the NCI was 200. At the year end, Adam sells 25% of Ant for 250 and loses control but retains influence through its remaining 45% ownership. The fair value of the associate retained is measured at 410. At the year end, Ant had identifiable net assets of 330 and the growth of 30 had been reported through the income statement. What is a bit odd about that yellow data that I have highlighted over my shoulder is that there's no detail in there. You know, we're used to having net assets split between share capital and retained earnings and all that kind of stuff. And it feels very weird just to be given the figures straight. But when you get a question like Adamant, that's how they're written. So you might as well get used to it. So on that basis, let's have a look at Adamant. Let's do it together. There we go. And that's just given in the question. Then goodwill. %. Like that. Is the 1 million recorded under investment income in the P&L? That's a very good place. I'm sorry, Lisa, I didn't see your question until then. Is the 1 million recorded under investment income in the P&L? That's a very good place. That's a very good place. Yes, somewhere in financing. You might remember me mentioning this when we were doing that wonderful question, pedal, saddle, handlebar, that there are essentially 3 sections to the P&L, and the 3 sections are operating, financing, and tax. And financing is fairly obviously interest, but it's also speculating gains and losses. So somewhere in financing would be the answer, but your suggestion, Lisa, is a very good one. So the fair value consideration, what was that? That was a figure of 460. Identifiable net assets, a fair value of 300. And the NCI was 200, lovely. So the goodwill is 360. What was the goodwill at the year start? It was 360. What was it in the middle of the year? 360. What was it yesterday? 360. What does it represent? The customer value. What happened as regards the customers? We totally lost control of the customers when we sold our 25% equity. We totally lost control of the customers. So we're going to de-recognise the goodwill in a disposal schedule. What's that? Not Brad. So let's start at the bottom. So what was the value of goodwill at the point that we derecognise it? 360. Goodwill doesn't change from day to day, but net assets does. So what we want all these figures to be at the point of disposal. But the goodwill at the point of disposal is the same as the goodwill at acquisition. That's why that figure hasn't changed. But net assets has changed. So we want, the net assets at disposal, which is at the year end. This figure here is 330. So 330. We need to derecognise that. Then we need to derecognise the NCI because, to have NCI, you need to have control yourself. To have other guys without control, you need to have control. And we totally lost control, so we've lost our NCI. We need to derecognise the NCI at the year end. NCI is always measured by roll forward. Do you remember this, baby? Acquisition plus growth. Let's just do it right on the face there. Acquisition plus growth. The NCI at acquisition was 200. And the percentage was 30%. And the growth was 30, rather cutely. So 30% of 30 gives us 9. That slapped on top of the 200 gives us 209. So the NCI at the point of derecognition is 209. Can you guess what's going on with the actual sale proceeds and the deemed sale proceeds? The actual sale proceeds is the actual sale proceeds for actually selling the thing you actually sold, 25%, and the deemed sale proceeds are the fake sale proceeds for what you would have got if you'd sold the thing you hadn't sold, right? So the actual sale proceeds are easy, you just get straight from the question. At the year end, Adam sells 25% of Ant for 250. That's a cash flow, that's not a guess. But what would we have sold the 45% for if we had have sold it? Well, that's a bit more difficult because we didn't sell it. Can you see it says the fair value of the associate retained is measured at 410. And what we're saying in yellow here is that if we had sold the 70%, we'd have got 660. Can you see that? If we'd sold the 70%, we'd have got 660. And we are required by law to pretend that we did sell the 70%. Because we are required by law to go through 0. So you pretend you'd sold the 70% down to 0 and then up to 45. And there's no way you can do this schedule unless you know the 0 rule. You're required to pretend that you sold the 70%, the whole 70%, and bought 45% associates. You're required by law to do that. So then we add down. You might have the figure already, probably quicker than me on a calculator. So 660 we said, didn't we? Plus 209 minus 330 minus 360 gives 179. Nice. Gives 179. And there is one bit of this question which sometimes gives a bit of trouble. Some students are not so bothered about it. But why is it that the NCI and the net assets have opposite signs? The reason these have opposite signs is because they have opposite signs. Goodwill and net assets are debit balances, but the NCI is a credit balance, so when you derecognise it, it has the opposite sign. And it's actually the reason that the schedule is traditionally done in this order, because it's quite hard to get that figure of 209 positive, but to encourage you to get that 209 positive, it's usual to show the schedule in the order that I have. How's that? It's nice, isn't it? Should we be on the safe side and do it again? But before I do so, let us have the 0 concept written down here. There's a question, I can see a big question there, but I'll give me a second. So I need black, here we go. Application of 0 concept to question Adamant. Application of zero concept to question adamant. I think you can see. So I'm going to say you can see. You can see that in question Adam and we pretend that we sold a 70% subsidiary and acquired a 45% associate. That's good, that. I'm happy with that. If the goodwill was impaired between the date we'd acquired the sub and the time the ownership was changed, is it correct that we will need to take it into consideration? It's a great question, that. Not an easy one, so I'll just repeat it for those of you guys watching this as a recording. If the goodwill was impaired between the date we acquired the sub and the time of the ownership was changed, is it correct that we need to take it into consideration? Absolutely. That's a question from Lisa, by the way. Lisa, have I said that right? Lisa or Lisa Gu? Yeah, Lisa. That's a question from Lisa. Lisa, you can say it like that, but it's the simplest thing to say is whatever is on the balance sheet immediately before the disposal, that's what you de-recognise. So if the figure on the balance sheet is a figure of 100, you de-recognise 100. And it doesn't matter whether you got to that 100 by just starting with 100 and nothing happens, or it went down from 125 to 120 to 115 and then down to 100. It doesn't matter how many impairments there have been. So yes, you take it into account, but I think you're overcomplicating the concept. The concept is incredibly simple. Whatever is on the balance sheet related to the sub, you need to de-recognise it, all of it. So what do you have at the point of de-recognition for a sub? Well, obviously, you know, all subs are made up of, let's use the colour. I'm going to go for orange here. So subs are made up of people and things, but also when you have a sub, you have NCI, and you just de-recognise the figures at the point of de-recognition, all right? So yes, it's the goodwill that you take into account the impairment, but I don't think that's the way to think about it. The way to think about it is the goodwill that you de-recognise is the goodwill in the morning. Whatever goodwill is in the morning, you de-recognise it at the point that you sell the asset, midday or whatever it is, okay? All right, great. Should we do it again? One more time? Let's do it again, one more time. So, example 2. A parent bought 80% of a sub at the year start for 80, should we say, for 80 million, when NCI was, let's keep it really simple, 20 million and net assets were 30 million. At the year end, net assets were 40 million. When the parent sells 35% for 40 million when the remaining equity has a fair value of 47 million. So a parent bought 80% of a sub at the year start for 80 million when the NCI was 20 million and net assets were 30 million. At the year end, net assets were 40 million when the parent sells 35% for 40 million. Have I got two 40 millions there? It's a bit unfortunate I've got two 40 millions there, but never mind, I've done it. When the remaining equity has a fair value of 47. Okay, it's not too bad. Required, of course, is profit on disposal. So off we go. So net assets are given at acquisition and at year end. And in this case, the growth is not given. We have to work it out for ourselves. The net assets were, let's highlight it, 30, and now at the year end they're 40, and the growth is therefore 10. 30 up to 40, 10. So that's where we go. 30 up to 40, 10. Nice. Then the goodwill. Usual dusual. So we have a split of 80 and 20 for the goodwill, and I think I went for 80 and 20 for the figures as well. And what did I go for net assets? Oh yeah, I went for 30 and therefore 70 for the goodwill. No need for the workings again as before. And then we derecognise everything, including the goodwill. And it does work quite well if we do the schedule in reverse. I quite like doing the schedule in reverse. Disposal. We've got the actual sale proceeds, the deemed sale proceeds, the NCI, the net assets, and the goodwill, giving me the profit on disposal. Maybe you're there already long before me. Should we do this one forward just for a bit of variety? So we actually sold 35%, if I remember correctly, and we kept 45%. Actual sale proceeds are easy because actual sale proceeds are actual, but deemed sale proceeds are difficult because they're fake. We didn't actually sell the 45%. So let's go and get that data. So let's see if I can highlight it. So let's stick with orange. Orange is good. So the parent sells 35% for 40 when the remaining equity had a fair value of 47. That's all right. That works well, doesn't it? So we've got 40 and 47. That's working for me. 40 and 47. So 40 and 47. The NCI we measure by roll forward. So we have the acquisition figure, which I've just completely forgotten. 20. plus, what was this percentage? 20% of the growth in the net assets, which was 10, wasn't it? Like that. So 20% of 10 is 2. 2 added on to 20 gives 22, so it's 22. And then we derecognise the net assets at disposal, which was 40, and we derecognise the goodwill, which was 70. And it's looking pretty marginal. It's not much of a profit, that one. So I'm being a bit lazy here, aren't I? So that's, is that a negative profit on disposal? Have I achieved a negative profit? That's 80, 109 and 110. Is it minus 1? Have I got minus 1? I got minus 1. Well, just check with me, see if you've got minus 1. Is that what you get as well, Chrissy? I got minus 1 as well. So there you go. And some students tend to be rather nervous of this language, and if you feel strongly about it, you go ahead and change it. Profit. I don't think that's hidden behind my head. No, it's not. This phrase profit, does it work with a negative profit? Of course, a loss is a negative profit. Some students feel, they really have to make a big thing about making that a loss of 1. But it's okay to say it's a profit of minus 1. It's fine. It's all right, So we don't need to change that. That's cool. We scored the marks. And the number of marks available for that, which has been examined repeatedly, is 4. There's only one consistency with your examiner, and that is his inconsistency, but usually 4 for that schedule. Which is good, isn't it? I mean, it's good 4 marks. If you can do it, that's a good 4 marks. And speaking of 4, there's 4 marks for Iggy Pop and Busta Rhymes. Speaking of 4, there's 4 marks for Iggy Pop and Busta Rhymes as well. Really nice stuff. The subject matter is called transfer, and I haven't told you anything about that yet. So let's go into the transfers. So where are we with the pen? There we go. Transfers. And both of the fellas on the right hand side, Iggy Pop and Busta Rhymes, they are in fact both transfers of ownership. And this occurs when there is a change of ownership, or change in ownership, a change of ownership with no change in control, which is essentially the power to fire people. I mean, the power to sack directors. Do you want to take a look at Iggy Pop? The important data is the percentages. I'll give you a chance to get that down, and then we'll flick to Iggy Pop. Here we go, flicky, flicky. Here we go. Iggy Pop. So here's Adamant. Bye-bye, Adam. And here's Iggy Pop. The important percentages are indeed the percentages 70 and 10. At the year start, Iggy acquired 70%. Is that transaction an acquisition? Sure is. Gives us control. At the year end, Iggy acquires a further 10%. Is that an acquisition? The examiners use the word acquires. Is it an acquisition? Slowly and carefully. Look at control. So yesterday we had 80%. Have I said that right? Yesterday we had 70%. And tomorrow we will have 80%. So tomorrow we'll have 80%. Yesterday we had 70%. If we had sacked directors yesterday with 70%, oh no, if we'd sacked them tomorrow with 80%, are they more sacked if you use 80% than if you use 70%? Don't be ridiculous. There's no percentage of sackedness. If you are removed, if you are fired, if you are made redundant, then the amount of sackedness you have is you're sacked, you're fired. So Is there any change in control here? No, we have control the day before, we have the control the day after, there's no change in control. What there is a change in is ownership. Our ownership has gone up from 70 to 80, but there's only so much ownership to go around. And there's two bunches of owners. There's us, called the controlling interest, and there's them, called the non-controlling interest. There's them, called the non-controlling interest, and us, called the controlling interest. And our controlling interest has gone up from 70 to 80, and their non-controlling interest has gone down from 30 to 20, because they have transferred ownership to us. And what's it called when they transfer ownership to us? It is called a transfer of ownership. So Iggy Pop is a transfer of ownership, as is Busta Rhymes. But unfortunately the examiner is inconsistent with his models here, which makes this subject, which is quite difficult anyway, even more difficult than it needs to be. So there's us and them, which is the CI and the NCI. And the examiner's favourite transfer direction is the one that you just looked at, which is from them to us. But he does also examine in the opposite direction. And annoyingly, we do something different in the usual direction, from them to us, compared to what we do in the other direction. What we do is we've got two P's. There's proportion and percentage. Makes no sense, but it is the law. That's what we have to do, because that's what the examiner says. So when we do Busta Rhymes, I'll just put that in red actually. When we do question Busta Rhymes, we will use the percentage model. And when we do Iggy Pop, we will use the proportion model. Okay, and we're going to do Iggy Pop first. But I'm just going to take Iggy Pop a bit further. I think I'll flick back to it actually, if you don't mind. Flicking back to Iggy Pop, can you see those two yellow percentages? Our percentage goes up from 70 to 80. But look at it from their point of view. They used to have 30%, but now they have transferred 10% of their 30% to us. They've transferred a third to us and kept 2/3 for themselves. They've transferred a third. 10% of 30%, they've transferred a third. And therefore the proportion that is referred to here, the proportion that's referred to here is the proportion of a third. And that's the basis of our answer to Iggy Pop. Let's do it now. So here's Iggy Pop. Here's Iggy Pop. And you get plenty of practice with goodwill. There we go, there's our goodwill. And a simple goodwill like that would indeed score 2 marks in any exams. The simple goodwills are very common, you know. You might think every one of them is complex, but usually there's 2 goodwills and one of them is simple like that for 2 marks. Having got the goodwill, we then do the transfer. I'm just going to start a new page here because there's a page break which is a bit awkward. So part B, we measure the transfer, and we measure the transfer from the perspective of the NCI. So the NCI before, at the year end, but immediately before the transfer of ownership. Do you remember the transfer was at the year end? They're always at the year end, but just double check. At the year end, Iggy acquires a further 10% of POP for 55. POP has made profits and grown by 20 over the year, and therefore the carrying value of identifiable net assets of POP is 130 at the year end. So at acquisition, NCI was 138 and the ownership percentage was 30%. So 138 plus 30% of, what was the growth again? 20, which is therefore 6. 6 on top of 138 gives 144. And back up again at the year end, Iggy acquires a further 10%. So it's not an acquisition, it's a transfer. And we look at it from their point of view. We take 10% of the 30%, we take a third of their 144, which is 48, and we leave them with 96, the other 2/3. NCI after, and then I'm going to write a shocking thing. Prepare to be shocked. Oh no, don't make me do a journal. Yes, indeed, we're going to do a journal. Debit this and credit that. Oh, drive on the left, crash on the right. Now, this is the NCI over here, or was the NCI. And as you can see, the NCI is going down by 48. And NCI is a creditor. To make an NCI go down, you credit the creditor. So we're going to credit the NCI. Did I say that right? I think I did. We're going to make the NCI go down, and in order to make a credit balance go down, you debit the creditor. Sorry about that. Not great for those of you struggling with double entry for me to get confused there. But all creditors work like this. When you want to make a creditor go up, you credit the creditor. When you want to make a creditor go up, you credit the creditor. And when you want to make a creditor go down, you debit the creditor. So I want the NCI to go down, so I've debited it. But I want the CI to go up by 48. But what's the T account called for NCI? NCI. But I've never heard of the heading CI. Which of the CI is 3 things on the balance sheet. It's abbreviations. It's SC, RE, OCE. OCE. SC is what you think it is, share capital. RE is what you think it is, retained earnings. But OCE is the new one, and that's where it goes. But Martin, what does OCE stand for? Well, in the exam, you'd never bother with that. But here, in the classroom, because it's the first time you've seen it, let's label it by its full name. It's called Other Components of Equity. Other components of equity. So it goes to other components of equity. And what does it make OCE on the balance sheet do? By the way, equity is 4 buckets, SC, 4 buckets, SC, RE, OCE, and NCI. So NCI is going down and OCE is going up, and all that you're doing is taking out a 1 bucket on the balance sheet and slopping onto another bucket on the balance sheet. And that's it. Not quite. Can you see that there's a figure in the question which we've ignored? It's a cash flow. It is consideration. At the year end, Iggy acquires a further 10% of POP for 55. That's called the consideration. The IFRS, which is IFRS 3 as it goes, the IFRS requires that the consideration, excuse me, my bottle's wobbling, that the consideration goes to OCA. How does that work? Well, let's do a consideration journal. Let's do a journal for the consideration. I'm not a massive fan of these journals, but they're very, very helpful in this context, I must confess. So debit and credit. At the year end, Iggy acquires a further 10% of POP for 55. Admittedly, it's not an acquisition, it's actually just a purchase. But the point is the cash is flowing out. Cash, bank, is an asset, it's a debit. And to make a debit go down, you credit the debit with 55. And then the law says the other side goes to OCA. I think I'm getting tired now because I'm not even sure I said that right, so I'll just say it again in case I said it wrong. So we credit the bank to make it go down, and we debit the OCA because it's the law. Why do we debit the OCA? Because it's the law. But why? Because it's the law. Okay, the ISB debated various places where that debit could go, and they decided they could do this, they could do that, but they're going to do this because it's the law. Okay, so that's the law. But have a look at this baby. Wait a second, hang on. Let's have some colour here. Wodja, look at that. There's a credit to OCA of 48 and there's a debit to OCA of 55. Back to the question. Can you see in part B, it says transfer from NCI and effect on controlling interest. When maybe you first looked at that requirement, you thought to yourself, hang on, surely what comes out of the NCI goes into the CI and that's the end of the story. No, it is true that what comes out of the NCI goes into the CI, but it is also true that cash flows as well. And the result is compound, as you can see. That's why you're getting your 4 marks. So let's go back in again. There we go, and finish with the effect on CI. So the transfer's coming in to the CI. Transfer in was a figure of 48, but the consideration was out. $55, and that gives us sausage 7 as a decrease to OCA. That gives us a decrease to OCA. And in your exam, what you would do is you would copy the examiner's OCA. Say he had a figure of 100. So you'd copy his 100, you go 100 minus 7 gives 93, is what you do. So 100 minus 7 gives 93, is what you'd do. But there's 4 marks for getting that figure, essentially. But there's 4 marks for getting that figure, and no marks for the journals. The journals are very useful in showing you the underlying mechanics. I don't want to overplay this, but one of the things that I find useful is just reminding myself that there isn't actually a 7. what there is there's a transfer in of 48 and there's a consideration out of 55. And in real life, I wouldn't have a journal for 7. I would have 2 separate journals, as you can see recorded up there. So in real life, there are 2 separate journals which come together to have the effect of -7. But you're not in real life, you're in an exam. And in an exam, you play the game how it's played, especially when that way is the quickest. And there's no doubt about it, this answer is much, much quicker if we skip the journals. But we've already done this answer, so let's test that theory by making up another question. I'm going to make up an example 3, and then I'm going to answer that without the journals, and I think then you'll see that, you know, this isn't easy, but it's not that hard. Well, I'm sorry guys, I just kicked my microphone. I don't think it's damaged, but it just caught the heel of my my shoe. I'm sitting on a bar stool here, you see. And I just caught my heel. I don't want to do that again, so I'm just going to... There's quite a long loop on this fella. So give me a yowza, if you can still hear me. Give me a wowza, if you're still hearing me coming through loud and clear. Yowza, wowza. Tell me yowza, wowza. I'll check in a second and keep going. I'm assuming that you're hearing me at the moment. So here we go. Good stuff, good stuff. So example 3. Here we go. At the year start, Iggy acquired... What am I doing? I'm just copying. Let's go with Iggy though. Shall we go with Iggy? No, a parent. Can't face it. Can't have another Iggy. A parent. At the year start, a parent... I don't want to copy the same question out. A parent acquired... I'll do the examiner's favourite one, which is starting with 60 and then buying another 20. Oh, I'm at the bottom. Let's give myself another page. So, all right, there we go. At the year start, a parent acquired 60% of a sub for, let's have nice easy numbers, 61 million, when NCI was 39 million and net assets were 30 million. Okay, that's looking good. At the year end, the parent acquired another 20%. The examiner's obsessed by this. 60 up to 80. Acquired another 20% for 25 million when net assets were 40 million. Nice simple growth of 10. Have I missed anything? After growth, let's write that down, after growth of 10. So we haven't got a group around for it. After growth of 10 million. Just double check I've got my 10 right. So, yeah, net assets were 30, now they're 40, they've grown by 10. Yeah, that question is internally consistent. Bit awkward, I'm just at a page break here, so I'm going to squeeze in the requirement. So required is, actually I have to no, let's do it like this.
Required is goodwill and effect on CI. That works. But I'll actually talk about the mark allocation when I do that. So goodwill first of all. Yet again. Gets us good at goodwill, this, doesn't it? Oh, goodness me. I am tired, aren't I? How's that? Have I done that right? Yeah, I've done that right now. And like I said, it looks a bit pedantic for this working section of the schedule, but really useful in the exam. That's why I keep hold of it. So it was 60-40. And I kept the numbers simple. I went for 61 and 39. I was thinking of 100, of course. And the net assets, I forget. Net assets were 30. Right, I'll just check my other figures. The year start, parent acquired 6% for 60. Yeah, I got that right, 61. And then NCI was 39. Yeah, this looks good. Looks like I picked up the data correctly. So, got that right. There we go. What were the net assets again? 30. Yeah. 30. So goodwill is 70. Smashing. And that is indeed 2 marks. I'll give it 2 ticks because it's 2 marks in the exam. That's worth 2 marks. Just that. And then we've got the transfer, which itself is worth 4 marks. First of all, the transfer itself. Where we measure the NCI immediately before the transfer, at the year end, but immediately before the transfer, as being 39 plus 40% of, what was the growth? It was 10, wasn't it? 40% of 10 gives us 4. 4 added on to 39 gives us 43. 43. And then the transfer is the examiner's favourite ratio. We look at this from their point of view. We've got 60%, as you can see, so they've got 40%, at least that's what they have originally, and then they give us half of their 40%, basically. They give us 20%. 20% of 40% is a half, and they keep a half for themselves. So 20% of 40% of 43 is 21.5, and they keep 21.5 for themselves. That's the NCI after, and that right there is worth 2 marks just for that. Whatcha? And then finally, the effect on CI is that the transfer that's coming out of the NCI is coming into the CI, so the transfer is in to the tune of 21.5, but the cash, the consideration, is out. And I think I said 25 for that, but I better go and check. Yes. 25, and that's out. So I'll put a sausage around that, I'll put brackets around that. And therefore we have sausage 3.5. We have a decrease to OCA. So say, for example, the examiner had an OCA of 10. We would copy his 10 and go 10 minus 3.5 gives me 6.5. There we go. Good stuff, good stuff, good stuff. Good job, Bob. Up to the top again, up to the top again. We've just done Iggy Pop, we're now going to do Busta Rhymes. But apparently the way we do Busta Rhymes is different because of this, you know, this slide over my shoulder. When we were doing Iggy Pop, we had the more complicated concept of the proportion. But now that we're doing Busta Rhymes, we just do a percentage. Now, we haven't read Busta Rhymes yet, and I don't propose to just yet. What I want to do is just stick with Iggy Pop, because Iggy Pop works quite well if I, you know, do it both ways. So if we go from Iggy Pop 70 up to 80, that's up, isn't it? And when we go up in our ownership, they are transferring to us. And when they transfer to us, you do a proportion of them. So 70 up to 80 for us is 30 down to 20 for them. So they transfer 10% of their 30% to us. They transfer a proportion. 30% on the bottom there, 10% on the top. It's a third, isn't it? 10% of 30%, they give us a third and keep 2/3 for themselves. That's the proportion model. But if you were to go down from 70 down to 60, what percentage is 10%? 10%. What if you go from 70 down to 65? 5%. What if you go from 70 down to 69? 1%. The percentage model is much easier and I prefer it. All you do is just copy the percentage and away you go. So let's do that for the question Busta Rhymes. Let's go and have a look at Busta Rhymes first of all. So skipping down to Busta Rhymes now, let's get the percentages. At the year start, Busta acquired 90%. Oh, pink, okay. 90%. At the year end, Busta disposes of 15%. Oh, the evil pixie has played a trick on us. The examiner is trying to noodle with our heads. He's used the word disposes to try and make us think that this is a disposal. But is this a disposal? Have we lost control? When we go from 90% down to 15%, we retain 75%, don't we? Which is plenty sufficient to retain control. And the same would be true if we went from 90 down to 55. But if you go from 90 down to 40 by selling 50, then don't do a transfer for this because it's not a transfer, it's a loss of control, it's a disposal. So if the 90% goes down to 40%, don't start doing a transfer because it's not a transfer, it's a disposal, it's an adamant. Okay? So make sure if you do lose control, you account for it as a loss of control. Make sure if you lose control, you account for the disposal as a disposal. But that doesn't apply here. This is not a disposal, this is a transfer. But what percentage, horrible colours now, what percentage is 15%? 15% is 15% and we copy the 15%. They're disgusting, those colours, so I'll get rid of them. And go over here. There we go. So now we're going to do Busta Rhymes. Busta Rhymes. Oops. Question Busta Rhymes. At the year start, Busta acquired 90%. So 90-10 for 440. The fair value of the identifiable net assets of Rhymes at the point of acquisition was 180. That's the net assets. It's 180. The fair value of the NCI was 40. Okay. So that gives us 300 in goodwill. And then the way that we calculate the transfer is just really irritatingly different. So B, the transfer, I've talked about as copying the 15%, but clearly we're going to multiply that 15% by something. The something is the carrying value. Yep, we're going to copy the percentage. The examiner gives us a percentage, and when we use the percentage model, we copy the percentage, 15%. But what do we multiply it by? The carrying value. What do you carry when you carry a subsidiary? A subsidiary is a business, so we carry people and things, goodwill and net assets. The transfer, of course, is at the year end. It's always at the year end, but the goodwill is unchanged during the year. So the 300 at acquisition is still 300 at the year end. But the net assets have changed. They change from day to day, so we need to read to get those figures, to get that figure. At the year end, Buster disposes of 15% of the equity of Rhymes for 90, and so reduces its ownership to 75%. Rhymes has made profits and grown by 40 over the year, and therefore the carrying value of the identifiable net assets of Rhymes is 220 at the year end. So it's 220 gives 520, and that then is the transfer. And it's not particularly difficult, this calculation, but it's very, very different to the other one, which is irritating, isn't it? It's inconsistent. But nevertheless, that's the way the examiner does it. And therefore, the way we do it, we get 78. 78. And our ownership is going down from 90 to, our ownership is going down from 90% down to 75%, and therefore this is a decrease to CI. So what do we need to do here? Fresh new, brand new page. So the effect on CI is we have a transfer out 78, and I'll put that in a sausage, and then we have consideration in, the cash flows into the group, and there's a figure of 90 giving us plus 12, and that is an increase to OCE. And that increase to OCE, we copy it, the examiner's OCE, the figure of say he's got 20, and we go 20 plus 12 gives us 32. There you go. Really good, isn't it? And very, very common examined as well. Okay. Excellent. So we finished the subject of basic groups in its entirety, and we now move to complex groups for the last half hour. Sorry about the problems with the IT earlier, but hopefully I won't get kicked out the building before I manage to finish with you today. Let's move on. Oh, there's a wonderful homework question, Hebrides. I mentioned this to you, didn't I? Wonderful homework question. I mentioned this to you last time I saw you. Great question, Hebrides. I'm just flicking through the pages here and I just saw it. So that was your homework from last week, and if you haven't done it, do it this week. Great question. There's another homework question coming at you in just a moment, but just at the moment I want to move to vertical groups. I want to move to complex groups. So fresh new brand new page. Open a fresh new brand new page in your own memory. Here we go. Complex groups. This is based upon the vertical group structure. This is based upon the vertical group structure. And there's a couple of examples of this. So we've got question ACR and question PDQ UK, which I'll come to in a moment. Question ACR first of all. So I've moved to the second chapter, chapter 2, complex groups, and I'm on page 39. I've in fact got the journal just behind me, so I'm going to bring it up. Here we go. There we go. So just flicking through the pages, actually it might be quicker if I do this. Page 39. There we go. There's ACR. Thank you, thank you, thank you. So here we go with some highlighting. A parent A buys 60% of entity C, which in turn buys 60% of entity R. So the parent's buying the mid-sub, and the mid-sub's buying the sub-sub. It is a vertical group structure, and the first of two that we're going to look at. So ACR, we have A, C, R, and we have 60%. Well, that looks a bit small, but there you go. That's the way it came out, and 60%. And what we're going to do quite naturally is look at this whole story from our own point of view, that of the parent, the ultimate parent, A, and we're going to ask the question, how much does A own of R? How much do we own of R? That's the question, okay? So down in R, we're going to analyse our ownership. And of course, if we own 60% of C and C owns 60% of R, then our controlling interest is 60% of 60%, which is 36%. And therefore the NCI is the other 64%. Hoya! Great. Which brings us to the second question, called PDQ. Now, question PDQ is called PDQ UK to remind you that you're not doing UK. UK is available, and chapter 14 is for those people who do choose to do UK. But UK is an awful lot harder than international. UK is designed for those students who believe very soon they will be signing an audit report. And only if you believe you will be signing a UK audit report in the imminent future would you ever actually need P2 UK. It's not just for UK auditors, it's for UK auditors who think that they're going to be partners very soon and signing the audit report, in which case you do need P2 UK, which is awkward because it's a lot more difficult, there's a lot more knowledge. If you're interested, if you are doing international, which is all of you, you should all be doing international. But if you are doing international and happen to be interested in UK corporate reporting, then chapter 14 is there for you to look at. Once you've passed the exams, you can have a look at it. And there's also videos related to it in the library, which I'll talk about later. But yeah, the reason I've labelled that UK is just to say to you, you're not doing UK. So if you've accidentally, got yourself into the UK stream somehow at the ACCA, you need to phone them up, you need to email them, you need to get yourself switched into international. Okay? Which brings me to PDQ itself. So P, D, Q, same kind of idea. And P buys 75% of D, which buys 64% of Q. And therefore the ownership down there, the controlling interest is 75% of 64%, which is 48%, isn't it? And therefore the NCI is the other 52%. There we go. Oh, wait a second. Let's have a look at the question requirement. It says calculate the NCI in the group. And actually there's two NCIs. So let's be a bit more careful with this one, PDQ. Let's be honest about there being two NCIs. This one's a simple ownership split of 75%, 25%. Well, there's nothing complex about that, I hear you say. Well, actually there is, but what is complex is, I suggest, very subtle, and it's this one letter here, C, for control. Do you remember what control is? Control is the power to direct activities. And we have control with a minority ownership. We do have a minority ownership. You're not imagining that is less than 50%. We have a minority, but we do in fact have control. Now, what is our ownership? We are up in P. What is our ownership down in Q? The answer is 48%. But here's a tricky question for you. How many shares does P own in Q? How many shares does P own in Q? Can you see the answer? It's right there in front of you. The answer is 0. The number of shares P hold in Q is 0, but we still have ownership. How can we have ownership? Through the complex process of an intermediary in between. We own 75% of D, and D owns 64% of Q. Ah, you're starting to get with it now. Control is the power to direct activities, and we have that power because we can fire Q directors. How do we fire Q directors? If you want to fire Q directors, you have to phone up D. Does D have the power to sack Q? Of course, 64%. What about if D argues with us about sacking Q? Can we sack D? Absolutely, because we've got 75%. So we have the power to sack the directors in Q without having any shares. We have control. That's what's complex about complex groups. This chain reaction thing. Subtle, isn't it? So the numbers are not too difficult, but getting the idea that control is not as simple as a percentage. Control is as simple as the power to direct activities. And if you have the power to direct activities, even through a complex chain, it's still the power to direct activities. D is a sub, obviously, but Q is a sub as well. Q is a sub. We have control of sub, okay? And the non-controlling interest is in the majority. The non-controlling interest is in the majority, but the non-controlling interest does not have control, because we do. Because we can sack Q and they can't. It's complex, isn't it? That's the thing to get your head around. Because the numbers are not too bad. Have a go at the numbers with me. So there's a nice little baby question called Hendrix, which is at the bottom of the page on page 39, but it's a little baby question, and I'll leave that to you for homework. The one I want to do with you is a slight jump up. It's called D. Question D. And the reason I want to do D with you is D is the other form of complex group structure. There's only two group structures examinable. There's the one you see here at the bottom of the page, called a vertical group, and then if you put in a pregnant belly, then that is a D group. Why is a D group called a D group? Because it looks like a D, of course. Cuter. So here we go. Let's have a bit of pink maybe for our D. There we go. Looks like a D, especially when I do it like that. But hang on. Where did you get the group structure from? In the exam, it can be quite tricky to read the information, and I'm going to read it for you. I'm going to read it with you. So, at the year start, on the 1st of January, Mersey bought 40% of Irwell. So Mersey bought 40% of Irwell, that's down there. On the 1st of July, D acquired 75% of M and 25% of I. Like that. There we go. And you can see I am cheating, I've done that before. It's quite tricky, isn't it, reading those two sentences and turning it into a group structure. Well, do bear in mind there are only two possibilities. And the two possibilities are either this fella or this fella with a pregnant belly. So when you're given something that sounds complex, it's either going to be one or the other, and I think that helps. So I suppose we better do the red stuff down here. Is that orange? No, that is red. So ownership. You have to learn two new phrases for D and splitting the ownership. It's the direct ownership and the indirect ownership. What do you reckon is the direct ownership? What is the direct ownership? See if you can give me that percentage. Oh, very good. Yeah, you've got some good stuff there. Direct and indirect. What is the direct? What is the direct? It's 25%. Did you get that? The indirect, can you give me that? Oh, it's good. Well done. Yeah, well done. The indirect is through the spine, through M. It is a bit of a squeeze. It's 75% of 40%, which is 30%. And therefore the controlling interest is 55%. And therefore the NCI is the other 45%. Oh, hang on, wait a second. There are two subsidiaries, so there are two NCI. Oh. So 75, 75, 25, like so, like that. So just using a little bit of colour here, the two NCI are 25% and 45%. 25% and 45%. Okay. But we're not done yet, because this question is more than just, giving the structure. This question is a real question with full detail. So let's go for it. It's asking for a group statement of financial position for the D group, so naturally enough we start with a net assets working. So we're going to do a net assets working in the usual way that you're familiar with. Net assets for M and for I at the usual measurement points. Acquisition, year-end growth. How does this feel? Does it feel familiar yet? Acquisition, year-end growth. And share capital doesn't change. Remember all these abbreviations? So we want M at 2 measurement points, I at 2 measurement points, and from those measurement points we get the growth. Share capital doesn't change. So the share capital at the year end is 20. So it would have been 20 at acquisition. Hang on, we don't know when the acquisition took place. Doesn't matter, that freezes. So, those figures are always the same. Same next door, 10 and 10. But of course it's not the same as regards the retained earnings, the RE. We do know the year-end figures are 172 and 170, because it's given in the question, on the balance sheet. But what we don't have is the two green fellas yet. And there's no other complexity in this question, so once we've got those green fellas, we'll be done. Like so. Like so. So there we go, we need the green fellas. And now I have to show you this annoying little detail in this question. It's very annoying, but here it is. In this question, which is taken from an examiner's article from 2009, it's quite an old article, the examiner has very frequently examined, you know, complex groups and D groups in particular, but he's never done this table. And I'm glad, because it's really naff. What he's done, it is his style, but it's not actually done this. He's given us two blocks of information, one of which is relevant and the other of which is irrelevant. There's the green information on the 1st of July, and then there's the yellow information on the 1st of Jan. Now, in order to get the right two columns of information, we have to go up to the top and look at the two dates, which is, like I say, in yellow, the 1st of Jan, and green, the 1st of July. Now, if you look at the first sentence, we are interested in the 40%. But at the year start on the 1st of January, Mersey bought 40% of Irwell. We're not Mersey. We're not Irwell. We're D. So we're not interested in that transaction at that point. We become interested later, but not at that point. But what about the next one? On the 1st of July, D acquired 75% of M and 25% of I. Of course, we are D. But that's a very complicated sentence. Try this translation. On the 1st of July, D got involved. On the 1st of July, D got involved. We want the green information. Therefore, we want the reserves there. I know it's really naff, isn't it? And you ignore the January information. That's true both for reserves and for NCI. You go for the green information. Okay? So let's go for the green information. So where are we now? So we've got 100 and 150. Yeah, that's good. So 120, 192, and growth of 72. Now, just to remind you the language that's used here, when we get to superstar level, we'll be using the pink area to split the growth. But we're nowhere near that yet. We're not ready for split growth yet, so we just got the growth. And next door, we get figures of 160 and 180 and growth of 20. We're certainly not going to split that. Then we go for goodwill. How are we doing for time? Sorry about this, guys. It looks like we're going to be going to 9 UK time. Maybe just before. Goodwill. Here we go. Oh, not being tight enough there. I need to be a bit tighter. So I've got two subs, so I'm going to stick them next to each other. So I'll be a bit tighter with this. M and I, M and I. And let's start with the percentages, shall we? Taking a look at the group structure again, we can see that, you know, the ownership split is 75%, 25%, and I've gone too far there, haven't I? I've gone all the way to PDQ. There's D, sorry. Perhaps I should have had a fresh new brand new page. You can see the ownership split is indeed 25% and 75% and 25%, and it's actually 55 and 45. But I'm just going to highlight what I want you to really copy. You'll feel this is quite cool when you do it. Obviously the 75 and 25 is fine, The 45 is fine, but can you see those two figures there? Take them both. And because you've done something similar on Lady Gaga, it'll feel cool, I think. 75%, 25%, and those three figures on the right. And the reason becomes obvious when you get into this. I mean, of course, that is 55%, but it's expressed as a compound figure, and it's very useful to have it that way, as you will see when you get into it. But essentially, of course, what we've done there is a net asset working, highlighting it in blue. The reason we did that 120 is so we can copy it. The reason we did that 60 is so we can copy it. So let's copy it in to our answer. Each one into our answer. So 120 and 160, like so. And then we had that trick with the NCI. We've dealt with that now. 1st of July is when we get involved, so we need 62 and 83 from the question. Do you see that? 62 and 83 from the question. All easy so far. And then we go back to the question. I'm going to go back to the question and show you this. I'm going to ask a bit of a strange question. The question I'm going to ask you is, how much did we spend when we spent 70 on M? How much did D spend when D spent 70? Have I got the right figure there? No, I've got the wrong figure. How much did D spend? I'm sorry, my eyes are getting tired. How much did D spend on M when D spent 200? How much did D spend? How much did we spend when we spent 200? We spent 200. And the reason for me asking that question is not immediately obvious until we go and have a look at this. I'll change colour here. How much did we spend when we spent 70? 70. But how much did we spend when M spent 80? Ooh, that's more awkward, isn't it? Is it nothing? How do we do this? M's not us, but M is our 75% sub. So how do we work? When M spends 80, we are deemed to have spent 75% of what M has spent. And of course, this transaction does hurt exactly like spending 60 grand, because you know, every time that M spends $1, we spend 75% of what M spends because it's a 75% sub. So anytime M spends, anytime M spends $1 on anything, stock or, financial instruments or anything, we spend 75% of what they spend. So to find out how much we spent, because it's all from our point of view, we have to factor in this ownership detail. So the 25%, how much did we spend when we spent 70? The answer is 70. But how much did we spend when our 75% sub spent 80? We spent 75% of what they spent. That's a bit complex as well. So 75% of what they spent is 60. And what this fancy bit of maths is telling us is it's everything's from our point of view, you see, is that let's get some yellow, 55% cost us 130. From our point of view, our 55% cost us 130. And that's how that's done. And now let's add down. So we get 142, and what do we get there? So is it 53? 53. And it's really tempting just to leave it there. Do try and remember this red fella here, highlighted there. Because most students do, if I'm honest with you. Most students are very good with this. But there's a detail here which is a pain in the backside, but it's the only way to make your balance sheet balance. And that is, let's revisit the logic and then look at the double entry. Why is it that we are accommodating the 60? Because our mid-sub, in which we own 75%, has spent 80. And when a 75% sub spends 80, it feels like us spending 75% of 80. It feels like us spending 60. But there's a kind of double entry way of looking at the same thing. What we have done is we've knocked 25% of 80 off the top of the balance sheet. We've knocked 25% of 80 off the bottom of the balance sheet. By multiplying by 75%, we have knocked 25% off the top of the balance sheet. And if you knock 25% off the top of the balance sheet, you have to knock 25% off the bottom of the balance sheet as well. You have to knock off 25% of 80 off the bottom of the balance sheet. So where do you knock off the bottom of the balance sheet? You have to knock off 25% of 80, 25% NCI. And that little adjustment which ends my answer is really, really difficult to remember. Last time this was examined, I marked 110 scripts, and of the 110 scripts, one student remembered to do the indirect adjustment at the bottom. Half the students remembered to do the red that you can see over my shoulder there, so that's important. You know, people are doing it. If people are doing it, you need to be doing it as well. But remembering the indirect adjustment at the bottom is very rare. So let's go and do it. Let's finish this question off. So here we go. Group. Position statement. We have goodwill of 142 plus 53 gives 195. We have absolute control of all of the net assets in the entire group. Some students misread the net assets line. I'll just make sure you've got the right figure. I'll actually go and pick it up for you. Make sure you're happy with the, the right figure, the right line, especially if you're getting tired. So here you go. I'm just going to highlight this in, what shall I go for? A horrible pink, shall we? So it's 600, 112, 180 is the net assets, okay? So just copy it across. In real life, of course, net assets wouldn't be net assets, it'd be PPE and, inventory and receivables, etc. But here it's just a simple little baby question. So we just copy those figures. 600 plus 112 plus 180, which gives us 892, whoops, and therefore 7, 8, carry 1, 1087. Then into the bottom of the balance sheet. We're almost there now, guys. Thank you for your patience. Share capital. Retained earnings. And non-controlling interest. With the horrible indirect adjustment at the bottom. So we copy the parent share capital of 100. And then, strictly speaking, it's fresh new brand new page, and you do the retained earnings and the NCI on a fresh new brand new page. If I'm really honest with you, on a baby question like this, I'm not sure that matters. So retained earnings is parent. And then both the subs are subs, so it's sub. So there's two sub growths. And the two subs are M and I. And the parent profits in the parent bucket at the year end is 770. We've got that lined up. There we go, 770. The two sub growths were, where are they now? They are 72 and 20. Can you see that in the net asset working? 72 and 20. So 72 and 20. And our total ownership percentage was 75% from our point of view and 55%, 55% from our point of view, which gives us therefore 54 and 11, and therefore 5, 6, 835. There you go. And then the NCI, we start with basic roll forward, which is acquisition plus sub growth. I seem to be doing this way every time. It's not exactly what I meant to do. Acquisition plus sub growth. Should we do M, and then the same again, acquisition plus sub growth for I and I. And the examiner is very fond of a column now for this detail, so we just pick up the stuff, pick up the stuff up there. And it works quite nicely. I think it might straddle a page. Does it straddle a page? It does, unfortunately, which is a little bit difficult for me to show you, but I'll do my best. So, going for a little bit of highlighting in bright red. It's going a bit crazy now, but we've got 62, 25, and 72. All right, like that. So, 62, 25, and 72. So that's 62 and 25% of 72, and the equivalent information on the other fella, which was 83 and 45% of 20. 83 and 45% of 20. 25% of 72 is 36, and the other one's 9. And then, what's the chances of remembering this? There's then that indirect adjustment. The indirect adjustment is related to M. Do you remember M has got the 80 in it? And what we did on the top of the balance sheet was we knocked off 25% of 80 in the top of the balance sheet. We knocked it off, made the goodwill smaller on the top of the balance sheet, and if you make the goodwill smaller on the top of the balance sheet, for the balance to balance, you have to knock off the same balance, knock off the same balance at the bottom there. And there's a mark for remembering that if you do. Very difficult to remember though in the exam. 162 plus 36 plus 83 plus 9 minus 20. And that doesn't look right to me. I'm cheating, of course. I've done this question before. I've done something wrong. 36 is not right, is it? You've probably got it up there, have you? Telling me that. 36 is a half, isn't it? I need to go half of a half. It's 18, isn't it? My apologies. So let's go for that. There we go. 18. Yeah, that's better. That's better. So 62 plus 18 plus 83 plus 9 minus 20 gives 152. And I'm cheating, you can tell I've done this question before. And we pick up 152, we pick up 835, we slap it on the face of the balance sheet. Let's see if we can end with a catchphrase. 835, 152. So 835 and 152. That gives us 7, 8, 1087. And the balance sheet balances. What's the chances of that happening in the exam? Absolute 0. Whoa, we finished. Fantastic. P2. P2, guys. Starts to get hard, doesn't it? We're only into lecture 2 and it's really accumulated. Everything that you really need to know, I will tell you. But everything I tell you, you really need to know. And you can see how, you know, this subject can build and build and build. It's a massive subject. Even the core is huge, and I'm focusing on the core. Really tough stuff. So that's a wonderful question, D. And now what I'm going to do is I'm going to bring up the slides over my head and talk about homework. Okay? How's that sound as a plan to finish off? So well done, guys. Practice question D. It's a beautiful question. Here we go. Let's bring up. Ah, it's gone. I'm sorry, guys. The thing I was going to bring up has disappeared. Can't be helped. What I'll do then is go big head and finish with a big head. So I'm going to go big head now. Here I am. Imagine a slide behind me telling you what you've done. You've done changes in ownership and you've done complex groups. There's no doubt about it. Changes in ownership comes up in every single examination. It's the pivotal point of this evening's work. And complex groups, it might come up, it might not. It doesn't come up every single section. Complex groups is actually less complex than the basic group technique of changes in ownership. Changes in ownership guaranteed. Complex groups sometimes, but certainly not every single exam. But the main thing is to make sure you can do the stuff that we did together. Because of course the stuff that we did together, I did. And you copied down, if we're really honest. So you've got to make sure that you can do these things. But you also have to test yourself with some homework. So what is your homework? Your homework is, to pick up the question from last time, that question Hebrides from chapter 1. If you haven't done it, it's still your homework now. But the homework for this session is the fabulous question Ronette. I actually have my paper notes in front of me here and I can see it on page 41. I'm just going to give Ronette a kiss. Mwah! Possibly the best question in the whole class notes. It is a babe of a question. Not only is there a detailed answer in the back of your class notes, but also there is a recording of me doing this lecture. And the recording of me doing the question, Ronette, is in the library. So if you haven't opened up the library yet, now is the time. This weekend is the time, okay? This is really a Saturday, Sunday kind of thing, not a Friday night kind of thing. Ronette is full on. So set yourself an hour, set yourself a couple of hours, have a go at question Ronette. You can be brave, you can do it yourself and then look at me doing it. Or, let's be honest, this is P2, maybe you should pull off a little bit. You can look at me doing it and then you can have a go at it yourself. But it's in the video library. The video library is the button at the bottom of this platform saying video library. Get in there, you'll find it's got chapters, go into chapter 2 and you'll find there's loads of stuff in there, including the question Ronette. It's that question Ronette I'm recommending. When I see you next time, we're going to be moving on to Forex, of course, foreign exchange, including foreign subs. Thank you very much for your patience over the last 1,000 years, over the last 2.5 hours. Well done, guys. I look forward to seeing you next time.